Welcome back to another episode of What's on Your Mind. I'm Chris Quill, and today I've got Anthony Iser and Ben Berggreen on the show. It's an absolute pleasure to have you guys. Thank you for both coming on the show once again. We've had quite an interesting start to the year. There's been a bit of a ramp up in volatility, which it seems like it might be settling a little bit now, and that's had a bit of an effect on sort of mid-cap stocks, growth stocks, and so on. So I'd be quite interested in kind of seeing how that sort of plays out in your portfolios, if you guys think of that, if anything. But over to you, Anthony, first, I think, today. What did you want to talk about?
Hi, Chris. Hi, Ben. And thank you. I've got a buy idea in a sector that has been beaten up a little bit with this volatility. Not purely just market volatility. There's underlying reasons for it as well. And there's a couple of charts that I want to show that, perhaps suggest that this might not be the greatest idea, but I'd like to explain why I think it is. So we've got two charts here, and it's basically surveys showing that Americans don't feel like it's a particularly good time to buy a house at the moment. And that's mostly to do with the inflationary outlook, and it ties in with consumer confidence. But you can see on the second chart here that it is much more skewed towards the younger demographics. So yes, 65 plus and the 45 to 64 bracket are still finding it a trickier time to buy a house, but that doesn't mean demand has gone away, and it doesn't mean they're not going to buy a house. It just means, they're not happy having to pay all these extra prices. So the idea I'm going to look at is driven by supply and demand. So we'll talk about that in a moment. Got another chart here just highlighting that the US market is undersupplied in the housing side of things at the moment, and inventory levels are very low at the moment as well. So supply is constrained on a whole bunch of levels. So the company that I'm going to look at and invest in is Toll Brothers. I think we've got a good trade here. So I've been looking at this one for a little while. Toll Brothers is the fifth biggest home builder in the US. It builds luxury homes, which is important for my thesis here as well. You can see a picture here of their sort of standard homes. These are pretty punchy, big homes right at the top end of the market for these large home builders. When I look at the quantitative measures and some of the key statistics for the company, it's a $6.8 billion market cap. There's a little bit of short interest out there, 3.65% at the moment. The stock's down 21% year to date, and that's broadly in line with the home building sector, and it's broadly in line with multiples. So the PE next 12 months is 5.6. We try not to think of cheap and expensive, but from a valuation point of view, we're not factoring in a great deal of growth over the coming years. Yet the numbers and forecasts at this stage indicate there will be sizable growth. Sales growth in this coming year of 19.2% is forecast, and 11.8% in the year after that. That's EPS growth of 53 and 18%. So from a quantitative point of view, it looks quite good. So why am I looking at this, though, in the face of some of those negative surveys that I mentioned at the start? I've got three reasons. The first one is supply and demand. As we saw from a couple of those charts, supply is very limited at the moment. There's a whole range of reasons for that. But of course, everyone's been talking supply chains, labour shortages, and input costs pushing up prices in a big way, which has led to construction slowing down. So that's limited supply, but demand has not gone away. In fact, demand continues to be very, very strong for this market. So yes, prices are going up. That supply-demand dynamic is in full effect, but demand is not an issue. So what we've got to focus on is the supply side, and can Toll Brothers deliver? Second point, which I mentioned earlier, is these guys are a luxury player. Average price is $844,000 for a home. Next highest is Tri Pointe homes out of the listed companies. They're at 636,000. That's a huge, big difference. And they're the only ones over 500,000. Everyone else ranges from 276 at the low end. Most are under 400,000 and a couple around the 450 mark. So this is the super premium name in these big listed construction companies. And that's important for a whole bunch of reasons. But primarily, they've got 20% cash buyers. So concerns about interest rates going up, concerns about the job markets are not really impacting the buyers for Toll Brothers homes. Secondly, on this front, as we saw in that earlier chart, the older demographics are less concerned about the issues of buying a home at the moment, how tight the market is and prices rising. These guys, Toll Brothers, have most of their buyers are second home buyers or empty nesters. So well and truly in that older demographic. So everything sort of lines up quite nicely to counteract some of those negative conditions. Third reason why I like Toll is operationally, they've been running at record levels in 2021. So we've got a backlog of orders of 10,000. That's up from 7,000 in the previous year. Now, a backlog in homes is a good thing because people don't rush off and say, well, it's not going to be here for another few months. I'm going to find another one. That happens with furniture or white goods. If you can't get the exact one you want now, you'll go and find another one. It doesn't work that way with homes. That is just deferred revenue. So we expect to see that coming through. They're owned and optioned lots, 81,000, up from 63,000. So again, a big inventory that they can fulfill on, and all of that coming in at lower costs. The 2020 number of new units signed up was down. So it was down 13%, but the value of these contracts was up 10%. So those high costs are getting passed through. So there will be some margin squeeze, but perhaps not as bad as some people are thinking. And I guess to the final point on where they sit is they are primarily in regions of the US that are seeing inflow of migration. So North, Mid-Atlantic, South and mountain areas, and along with the Pacific coast. So I've got a table here from one of their presentations just highlighting exactly where they're at. Areas of growth, again, giving us a lot of comfort around that demand side of things. The risks, so we've got winter at the moment, obviously. Seasonally, this is the worst quarter. Does that mean that they could disappoint a little more than perhaps they would under normal circumstances? Maybe, maybe not. I think the market's probably not too concerned by this quarter. It's going to be much more about the outlook. Lumber prices, the worst of 2021 are getting factored into this quarter. So there is the potential that could be a negative. But again, when we look at what the company said about this, they are quite relaxed that they have factored in these into their forecasts. So, we'll wait and see on that, but it does look reasonably good. And then these stocks have been under pressure last year at various points in times when they had to slow down sales because they were struggling to deliver because of those things that we've talked about before, supply chain constraints, labour costs, and uncertainty around input costs, particularly lumber. January, there's every indication that things have slowed down again deliberately, not because of lack of demand, simply because inability to supply. And that remains a risk, but it does allow for a big build-up of that backlog. So that could happen again, but I think the risk is pretty minor. And if we structure our trade in the right way, if it does turn out that there's going to be another delay by a quarter or so here, it won't be the end of the world because we'll know, I'll know what my risk is up front. So I'm buying March $60 calls. They're $2 each. The stock's around about 57 today. It's post market close on Wednesday. I think this stock can potentially move to 70, 75 in the short term. It is one that, if it doesn't surprise on this result with its actual earnings, it's going to be very focused on the outlook. And that's coming out on February 22nd. So that March contract gives me plenty of time to take that catalyst into account. So that's my buy idea. Back to you, Chris.
Yeah, great. That sounds fantastic. Thanks for that one, Anthony. Ben, let's switch over to you. Have you got anything that you want to talk about in terms of longs?
Yeah. So before I get on my idea, I want to go over a few macro points first. It's looking at the latest ISM report from last week, specifically the manufacturing PMI, and when you look at the way things have shifted over the past several months, now it's like, obviously there's a big fear of inflation and high interest rates is kind of the narrative going on these days. And inflationary pressures, and there's been definitely pockets of inflation with crude, grains, metals, and other raw materials. But I think this whole kind of fear, if you will, of runaway inflation and drastically high rates could be overblown here. So, PMI has actually fallen for the past 9 months, and if we look at the data from the ISM report, it really shows the economy is actually cooling off, right? So inventory levels have stabilized. Material prices overall, as in the material price index from the PMI report, has actually fallen, okay, over the past 6 months or so. And also backlog of orders are falling. And the big thing, that they talk about a lot is the supply chain gridlock, which, yeah, it's a real thing, but there are signs now that we are turning the corner on that, okay, that we probably passed the worst of it. I think, what could happen is we have all this supply in the pipeline, materials and other stuff, and when the whole supply chain really starts, speeding up, we could be flooded really with things that we are now in a lack of. And that could definitely keep a kind of a cap on inflation and keep the rate hikes relatively mundane. So that's that. And also, if you look at rate sensitive assets, right? So there's small cap stocks, a lot of high beta names have really strongly rebounded here. I have a chart here of this is RTY, is the Russell 2000 index as the futures contracts, and there's been a pretty massive rebound. We saw that follow up for that today also, right? So, and further on, if you look at the VIX, the VIX was cranking up at 40 not too long ago. Well, now it's pulling back to 20. We kind of back to a normal market, if you will. With looks like this crazy volatility is coming down. Rates will probably settle down, and we can see kind of more back to normality in a lot of these names. So that really feeds into my trade idea, right? Which is long Abercrombie, symbol is ANF. They are a retailer, not just here in the States. They're a global retailer, focusing on kind of fashionable clothing mostly for young adults, think millennials, Gen X type of people. There are two segments: Hollister, which is the more casual, and Abercrombie, which is more stylish. And it's a $2 billion market cap company, but they have a pretty wide reach still. Okay, they have over 730 stores globally, and over 3.1 billion in annual sales last year. So that sales figure is it's a big sales figure, but they actually started losing traction in 2013. So the revenues has been kind of fluctuating between 3 and 4 billion since then. But then what happened is they have aggressively been rebranding to try to make it, kind of cool again, and appeal towards the fashionable millennial Gen Z market. So if you look at the quant side of things, a lot of the retailers now are showing strong growth numbers with very reasonable valuations. ANFP is around 8. The price of sale is a little over a half. Okay, so, and he has over 700% earnings growth for fiscal year 1. And it also has the past 3 quarters has really a strong tendency of surprising in a big way on the earnings release. So their gross margin is 63%, which is almost double the sector median. Right. So there's a kind of a sector catalyst here, which is really kind of a reopening play from COVID. And then there's also a more specific stock catalyst. Right. So let's look at the sector catalyst first. So they are, now the vaccination rates in a lot of countries, especially in Europe, over 80%. And I have a lot of family in Norway and other places in Europe, and they are now starting to open things up again. All right, we're now obviously in the middle of winter, or kind of like just getting out of it. There's a lot of people, a lot of my family in Norway, been stuck inside, kind of semi-quarantined. Well, guess what? There's going to be most likely a massive rebound of people going out, to restaurants and travel and whatnot. Another thing is that even though there's actually been an increase in infection rates globally, the reactions are just not that bad. Like I had COVID, my wife had COVID, my daughter has COVID, pretty much anybody I know here had COVID. And we all, still breathing. And I think that's kind of been the revelation, if you will, that is just not as bad as people were scared of. So they are opening things up. And, at home, I don't know about you guys, but at home, you don't really care what you wear so much, especially the guys, slapping around in your pajamas, stuff like that. I think it's time for a lot of people to renew their wardrobe. All right, they're going to go to a lot of these clothing companies. All right, so why Abercrombie? What's so special about Abercrombie then? Well, first of all, it's the rebranding that I mentioned earlier. But really, more recently, in October last year, they launched same-day delivery across all U.S. stores. That is a pretty big deal, to order. You need to go out. You're going out at night, and you can literally order clothes for the night and get it that same day. And they partnered with a lot of some third-party companies, such as Uber and Postmates and some other ones. So that initiative really transforms their supply chain and raises the bar for delivery capabilities in this space, right? And they have over 55% of trailing sales is made through online ordering. So that's a pretty big deal for shareholders. Another thing that I like to look at, for those of you who know me, I do like to look at charts. And in this case, I have a chart here, a monthly chart or ANF, and I have the 12-month trailing EPS, okay, overlaid on the chart. And you can clearly see how this stock price is fairly closely tied to the EPS as far as price moves. And, a lot of companies, not just clothing, but a lot of other companies too, got obviously crushed when the earnings got just smashed, right? When the COVID crash 2 years ago. But this company has had a massive rebound. So earnings per share is now 442, and that's the same level it was back in 2007 when the stock price was at $80. And the stock price, when I wrote this up over the weekend, was at $38. And if you zoom in on the kind of time frame, that the stock has showed strong support at 36 and is in this very fine uptrend with higher highs and higher lows. They did have a massive gap down it was actually end of November, and it looks like that gap will fill at 45, which will probably serve as resistance in this case. I like to use pretty basic price action analysis to help me structuring the trades, especially when it comes to picking strikes. So if you look at this options chain that I have here, to buy the May 40 calls could work combined with selling the March 45s. Okay, so for a diagonal spread, just a 1-for-1 diagonal spread. And I wrote this up. The May 40 calls were bid at 350, offer at 380. So if we consider it fill mid-price at 365, the March 45 calls could have gotten sold at about $1. So the net cost is $265 per contract, right? Which is the max loss also. Now, let's presume that the stock actually gets to 45 by the March expiration. Then the long strike will be worth around $689. And I go into how you calculate these numbers in mentoring. Okay, but $689, the March 45 short strike will expire worthless, letting us keep the premium. And at that point, we can either sell the May 40s for 160% profit, okay, based on the initial $265 cost, or keep it alive, sell a higher strike into May and just continue riding it. You know, you can also just do nothing, keep the May 40 strike on board for the next couple of months, and in that case, the profit potential is unlimited. So I really like this. You know, I like this space, specifically this stock, and there's also some other stocks that I look interesting here. So yeah, go out there and get some new clothes.
I was just going to say, I like that one. I particularly liked how you dropped a hint that Anthony and I require a new wardrobe. Exactly. But cool, thank you for that, Ben. Anthony, let's go back over to you. What else have you got?
So while the market's this volatile, but even during less volatile times, always like to have a pretty good balance of long and short ideas. So I've got a short idea. It's in a SPAC. I won't go into the details of SPACs, but essentially they're blank check companies that then merge with an unlisted company to form a listed company. In this case, it is Digital World Acquisition Corp. The ticker is DWAC. And people may have heard of this one because it's intending to merge with Trump Media and Technology Group, which is Donald Trump's Media and Technology Group. We'll get to that in a minute. There's a little bit of short interest, about 12% short interest on this company at the moment, but there's a bunch of reasons why I think it is a pretty big short. This is also a really interesting company for anyone looking at it, and I certainly found this myself, to just test how independent and how focused you can be on facts and put aside any emotion, because Trump is a polarizing guy. There's people who think he's the second coming of Jesus. There's people who think he's a criminal buffoon. We have to put all that aside and just look at what we know about this company and this deal. So I've done that. I've looked at it, and there's a bunch of things here that I think lead me to thinking I'm going to short this one. The first one is regulatory uncertainty. So at the moment, this is still the blank job company with an intention of merging with the Trump Media private company. There's already an SEC investigation into this, and coming from two angles, which could sort of scuttle this deal. The first is the advisors, ARC Capital, are a Chinese firm. Now, that doesn't make them crooks, but it doesn't sort of provide any great deal of clarity. But when we look into this firm in a little bit more detail, we find they've got a bit of a track record of having deals not go very well. So the SEC has issued 25 stop orders over the last 42 years. A stop order is basically looking at a deal and saying, this is so bad, we cannot let it come to market. So it's 25 over 42 years. It's not very many. This firm, ARC Capital, its key principals have been involved in 3 of those 25. So Go Easy Corp, ARC Lifestyle Group, and Nova Smart Solutions are the 3 that had stop orders put in place. So that doesn't bode particularly well for this deal getting up. Secondly, the SEC is looking at the CEO about breaking security laws around SPAC listings. You are not allowed to have discussions with potential targets when you're listing your SPAC. The CEO has made public announcements effectively suggesting that he had done that and in breach of these laws. So what does that mean? At best, it's going to be pretty messy. At worst, if this deal doesn't go through and it gets stopped, then the stock is going to trade back down to its cash backing. As I said, this is a cash box. The cash backing is $9.80. The stock is currently trading at $84. So you're looking at sort of 80 to 90% downside if that deal gets scuttled. The second reason why I think this is a pretty big short, and you may have noticed that there's not a lot of financials, so I couldn't mention anything about that side of the business, but I haven't even mentioned the market cap. If you go and look at the market cap on any trading platform, it'll tell you it's around about $3.1 billion at the moment. And that is technically true. That is the value of the cash box. However, when we look at the merged entity, we find that the merged entity, the cash box component is going to be around about 13%. So I've got a slide here of the transaction overview. This is from the Trump Media Group presentation. Lots of detail on here. The essence of it is this is going to be 13% of the merged vehicle. That effectively makes the current market cap of the valuation of Trump Media Group closer to 18 to $20 billion. That's an outrageously large number for what essentially is an idea and a concept at this stage, which is my third point. Currently they have no business. They potentially have no employees either. Looking at another slide from the presentation deck, at their technology team, you'll see something highly unusual, never been seen before. Basically, no one's willing to put their name to it. All the employees are first names and an initial for the second name. If you go and look through LinkedIn, it's very hard to find anyone who says they actually are working on this business and this product, which should have been up and running by now. The website uses open source technology. It does claim to be proprietary technology, but it's not at this stage. And it was due to launch in December. But if you go to Truth Social, you'll see that it's just a website collecting email addresses, and we're now sort of mid-February. So there's not much of a business here at all at this point. So then we look to my third point and looking forward and saying, okay, well, nothing here now, but there must be something building for the future. And again, all we've really got to go is the presentation. The presentation has very aggressive revenue projections in terms of users, most of them coming through the Trump Media Group, which is basically a subscription model for TV programs to compete with Disney, Netflix, and the like. And they're forecasting 16 million users in this coming year, growing to 81 million users by 2026 and generating substantial revenues. At this stage, it's very hard to see how that's going to happen this year, and perhaps they can in the later years. We can give them sort of, if we give them the credit that might just simply be delayed. Even then, these long duration companies are not what we want to be seeing at the moment. We don't want to have to trust a company to be providing revenue and a business in 2026. That's all changed with this focus on rising interest rates that we're going to see this year. And as Ben pointed out, maybe it won't be the 7 rates that Bank of America is talking about or the 5 rate rises that's average, but it's going to be starting next month in March, and it's going to impact, and already has impacted, long duration companies like this, although it hasn't impacted DWAC just yet. Final point, I guess, with regards to operations and growth, while these forecasts appear to be sort of broadly just made up, nothing substantial to justify them, everyone who's tried to take on the big players has found it really tough. So whether it's Parler, whether it's Rumble, whether it's Gab, who are essentially products that this group is looking to replicate, but with the gravitas of Donald Trump being the key component, all those companies are struggling. They've got solid products. They're struggling to get users, they're struggling to get advertisers, and they're struggling to find a way to take on the big players. If we were to say, rather than launch this product, that Donald Trump went and joined Parler or Gab or one of these other groups as their chairman and perhaps an operational role, even then it would be hard to see how you could get to a $15 to $20 billion valuation. So that's a real concern for me. So final point is, as part of this SPAC process, there's a thing called a PIPE, and that's essentially additional money to be raised from professional investors before the full merged entity happens. And $1 billion has been raised. And so we say, okay, well, why would people put money into this if the concerns that I'm talking about are real? And essentially, it's the structure of the PIPE deal and the structure of this SPAC and potential merger. The pricing of these shares have already been done. So it's $33.60. The current price is $84. So at the moment, even though if we were a professional investor taking on this $33.60 price, we wouldn't need to pay that until the deal is announced and completed. However, we can short the stock now. So if I've taken on 1 million shares at $33.60, I can sell them in the market now. I can short sell at $84 and I've got a guaranteed profit. And that's why people have taken it on. If the share price was to come all the way back, that $33.60 price will get adjusted down. But for the time being, it is essentially free money. So that's why that's happened. And that's another reason why I think it's coming down, and the market thinks it's coming down as well. And I'll get to that point in just a moment. Deal still needs to happen. An S4 needs to be lodged with the Securities Commission. This may not happen, but it has to happen if they want a merger to go through. And if, as I said earlier, if a merger doesn't go through, if the deal's scuttled, then we're back to 980. So how do we play this out? The options market is pretty tricky because, for the very obvious reasons that I've discussed now, the valuation is more than likely to be significantly lower than what it is trading at currently at $84. So the skew in implied volatility towards puts is outrageous. You can see the put prices are basically at the money, or the equivalent percentage out of the money, more than double the price of calls. So it's really factored into the put prices that there's a real risk here. And if we look out to, say, June, if we were to buy $80 puts, the cost is about $40. The market is factoring in, you need the stock to halve to get to break even. So I'm looking at a different way of playing this. I'm going to short the stock outright. As we all know, the risk of that is if there's a huge spike, and maybe that comes with the announcements of a deal. But if there was a huge spike, then I can potentially get blown up. So I'm going to buy June $100 calls for $10 to protect against that. So shorting the stock here at 84.5, buying calls at $100 strike for June to protect it. If the deal falls through, this moves quickly back towards the $10 mark. If the deal is announced and goes through, you'll have the remaining PIPE investors selling as rapidly as they can to ensure they lock in that free money. Either way you look at it, I think there's real concerns that there's just not an underlying business that's worth very much at all here. Maybe the idea and concept alone is worth $1 billion or $2 billion. That would see us back to $10, $15, $20 share price anyway. It's hard to see how a $15 to $20 billion valuation can be put on it. So that's my short idea. I've got a lot of conviction about this one. I am concerned about a spike given the nature of Donald Trump, and it's probably the ultimate meme stock. But $100 calls protects against any disaster on that front.
Yeah, that whole situation is pretty fascinating, actually. I did particularly like the way that you're structuring it there, because even though obviously you're short the stock, you want to protect yourself on the upside, and the vol's kind of in your favour in that sense in terms of pricing as well. So that was really interesting. Ben, let's go back to you then, just before we sort of close the show. Did you have anything else you wanted to talk about today?
Yeah. So, yeah, Anthony, that stock really reminds me of some of the dot-coms back in the 90s that didn't have anything but a name. And so pretty interesting. So I have another long. Yes, it's not a long, but it's a completely different animal. All right. So this is Transocean, or symbol is RIG. So RIG is a $2.5 billion market cap energy company. They provide offshore drilling services for oil and gas wells all around the world, so globally, leasing out their equipment to production companies. Okay, so they have real cutting edge rigs capable of ultra deep water and severe harsh environments. And there's some interesting stats here from the website. Is more than 80% of their 27 ultra deep water rigs are less than 10 years old. So they're not hampered by huge maintenance costs. And nine of them were actually delivered the past 5 years. And this is pretty insane. But their max drilling depth is 40,000 feet. I don't even know how that's possible, but that's what they can do. They also have 10 really harsh environments, semi-submergible, with their own propulsion systems. So they have rigs for really difficult drilling environments. Okay, so there's a lot that goes there. There are definitely a few levels that goes into this. So just bear with me. Fundamentally, the stock doesn't look that great. Okay, the stock price, when I wrote this up a few days ago, was at $3.50, and it used to be at $160 back in 07 or in 08. So it's, and the revenue has pretty much collapsed during that time also. I have a chart here with a monthly chart of RIG with in this case, I have the revenue overlaid on the chart, and you can clearly see how the stock price has reacted 6 to 12 months before the actual revenue movement, which is very typical, when you look at trailing fundamental data. So the price topped in 08 at 160, and then 6 to 12 months later, the revenue started sliding, and it stabilized at at around $3. They were, even though they have quite a leveraged balance sheet, they have been able to avoid bankruptcy. Have they been struggling? Yeah, they've definitely been struggling. This is a turnaround play. Okay, what this leverage on the balance sheet means is that when they get top line improvements, that will be magnified several fold at the bottom line, right, for equity holders, which will impact the stock price. And obviously, if this stock too is pretty closely tied to what's going on in crude oil, and if crude oil all of a sudden dramatically turns lower, because who knows, like the whole Russia-Ukraine situation calms down and whatnot, then it could definitely be more struggle ahead. As far as valuation, price to sale is less than 1 at 0.9. Okay, and just to put in perspective, at one time it was over 10. Price to sales over 10. So this is a very, very deep value play. Now, we don't typically get that excited about value plays, but the reason why I'm looking at this one primarily is because of what's been going on in crude oil. All right, so I have a chart here of RIG and crude oil futures overlaid on the same chart. And as is typical with a lot of energy companies, is that their stock price is very kind of tied with performance of crude, kind of tied at the hip. Not an exact correlation, but fairly close. And I don't know if you guys have been paying attention, but we had a massive rally in crude oil. It's kind of getting sucked towards that $100 level. while and that has most energy companies has been rallying. Energy is pretty much the only equity sector that has been doing really well the past year to date. But rig hasn't really budged. Well, it budged today. It was up like 5% today, but it's still sitting between $3 and $4. And I'm going to show you how this relationship will probably reassert itself. So the catalyst here, besides the flying oil price, is rig utilization. Okay, so I have a little chart here on the side you can see, but rig utilization has risen with the fleet attrition, but the day rates are the daily cost of renting these rigs. So day rates are still really low. But what happens is when utilization gets closer to an inflection point, that's when day rates really start cranking higher. And we are approaching that inflection point. Inflection point is around 80 utilization. And as you see on this chart, we're getting fairly close to that. So when that happens, we could see a massive turnaround in day rates. Okay, and another thing is, as far as a technical picture here, I mentioned that the stock has always come down from some massive levels, but it's still now in this kind of very contained uptrend. Stock broke out on January 11th on heavy volume, where it's traded over 20 million shares, and it kind of started this current move. And I think with everything going on under the hood here, this stock could easily hit $5 over the next few months, and and way beyond that. And because this is a very low price stock, this is just a straight up simple long call play. I like to throw some of these into my book once in a while, because these are the type of trades that can give you crazy returns. So at the time I wrote this up, I'm looking at the May 4 calls, okay, and I could buy them at 40 cents. That means that if the stock goes to $5 by the May expiry, the profit is 150%, right? Versus the 5 price point minus the 4 strike minus the cost. So the net is a 60-cent return based on a 40-cent investment. And if the stock goes to $10 and beyond, the return can be well over 1,000%. And so that's why I like this. This is kind of one of those roll the dice type of deals where, you're risking your small premium expenditure, but you can have some serious returns on these type of trades. So that's pretty much a wrap.
Yeah, cool. Sounds like a good one to kind of add to the portfolio as a bit of a diversifier as well, which is something we actually talked about in the last episode of What's on Your Mind. Excellent, gents. We'll end the show there. It's been an episode full of insights and great ideas from you guys. It's worth mentioning to our audience as well that all of these ideas that the guys have been discussing today, they're all in the context of their own portfolios, of course. It's what works in their own structure and stuff like that. But yeah, really great to hear from you guys today. And as I said, loads of insight, and our viewers will get loads from it. So thanks for coming on the show again. For you guys watching, I mentioned this last week on the previous episode of What's on Your Mind, but if you want to find out more about what the Institute does or get educated further beyond what you see on What's on Your Mind, then we've got loads of stuff available on our website, itpm.com. We've got information on upcoming events, that's webinars and seminars. We've got courses up there, recently released PTM course, new PTM course. We've got a whole bunch of things up there. We've got mentoring programs as well, and that's all with guys that you see on What's on Your Mind. And as I mentioned again on the previous episode of What's on Your Mind, we do have the War Rooms event coming up as well. I think that's towards the end of March. I won't go into details about that one again. Just find out more on our website, and you can decide if you want to go for it. But that's it from us today. I hope you all enjoyed the show, and we'll catch you next time for another episode of What's on Your Mind.